So you want to work for a hedge fund, but how many hedge fund strategies can you name off the top of your head? In this video, I'm going to be talking to you about the 7 most common hedge fund strategies, and I'm going to use an easy to understand example to explain each one. So regardless of whether you're a seasoned investor or if you're just starting out learning about hedge funds, this video should be useful for you. The 7 strategies are long short equity, event driven, global macro, quantitative, distressed debt, multi-strategy, and emerging markets. The first strategy we're going to be talking about is long short equity. This strategy involves buying stocks that are expected to rise in value, so taking long positions while simultaneously shorting stocks that are expected to fall in value. For example, a hedge fund manager might buy shares in a company they expect to grow, whilst at the same time selling short shares in a competitor that they expect to struggle. The beauty of this strategy is that it allows the hedge fund manager to profit from both long and short positions whilst minimizing market risk. Alright, the second strategy is event driven. So this strategy enables hedge funds to profit from events that happen in the market, such as mergers and acquisitions, bankruptcies of companies, or restructuring of companies. For example, a hedge fund might buy shares in a company that's about to be acquired. And the reason for that is that they hope to profit from the price difference between the company's current price and the price that it's going to be valued at after it gets acquired. Hopefully it will increase in value, and so they will make the difference as a profit. The hedge fund might also buy shares in a company that's recently or is currently being restructured or has faced bankruptcy. And the reason for that is that they hope to profit from the potential turnaround. Yo, before we carry on, if you're interested in learning from the trainers that teach the top 4 global investment banks, analysts, and associates, check out the first link in the video description and use the code AFSAL25 and you can get 25% off all of their courses. Now let's get back to the video. The third strategy is global macro. This strategy focuses on investing in various asset classes ranging from stocks, bonds, currencies, commodities, so on and so forth. The global macro strategy allows hedge funds to invest across a broad range of asset classes in order to benefit from macroeconomic trends and geopolitical events. So basically what's going on in the world, what's going on in the news, these impact the various asset classes, and hedge funds use global macro to take advantage of that. For example, a global macro hedge fund manager might invest in gold if they think that inflation is going to increase as it is right now, and as a result have a declining effect on paper currency. Alternatively, they might invest in emerging markets or developing countries because they think the prospects for economic growth in those regions are impressive and likely positive, and so they'll make those investments because that's part of the global macro strategy. The fourth strategy is quantitative. This strategy uses mathematical models in order to analyze tons of data and kind of come up with potential investment opportunities. For example, hedge funds might use data to analyze which stocks are likely to outperform compared to their peers based on a number of criteria. These criteria can come in many forms, some of which include earnings growth, price momentum, or other value factors. So they get one stock, compare it to its peers based on comparable criteria, and if they believe, or if the mathematical model believes that this stock will outperform over a given time period, then that is basically quantitative strategies telling you invest in this equity or stock or whatever it might be. And so to be even more efficient, quantitative hedge funds will use these computer algorithms in order to execute the trades in order to generate returns. Alright, the fifth strategy is distressed debt. This strategy involves in investing in companies that are in financial distress with the hope of profiting from a potential turnaround. For example, a hedge fund might buy the debt of a company that is struggling but has valuable assets, and they do this with the hope of either negotiating a debt restructuring or seizing those assets in a bankruptcy proceeding. This strategy can be quite risky, but it can also lead to quite high returns if the hedge fund manager makes the right decisions. The sixth strategy is multi-strategy investing. This strategy involves combining several different investment strategies to diversify risk and generate returns from multiple sources. For example, a hedge fund might use equity, long short, event driven, and quant strategies to balance out their portfolio and reduce the overall risk. This strategy is often used by large hedge funds who can employ tons of analysts and traders who can execute the investment strategies at the same time. And last but not least, we've got emerging markets. This strategy involves investing in the stocks, bonds, commodities, currencies of emerging market countries with the goal of profiting from their potential economic growth. For example, a hedge fund might invest in companies that are poised to benefit from the growth in China, India, and other emerging markets. This strategy can be risky, but it can also lead to potential high returns if the hedge fund manager makes the right decisions and guesses or invests in the right potential emerging markets. It's important to understand that hedge funds come in different shapes and sizes. They focus on different strategies. Some do all of these strategies, some do 1 or 2 of them. It's also important to understand that each strategy comes with its own risks and rewards. If you're interested in breaking into a hedge fund, it might be worthwhile looking at these strategies, doing your own research, and see which ones interest you, because that will dictate to a large extent which applications you do and which hedge funds you apply to. So you don't want to apply to a hedge fund that focuses on global macro and you're talking about your interest for emerging markets, for example. With that, if you made it to the end of the video, let me know if you've got any comments or questions. If you want any future videos on hedge funds, what exactly do you want to know? Leave a thumbs up on the video and I will see you in the next one. Peace.